You worked your whole life to build a nest egg, and right now you probably want to use a piece of it to help your adult children buy a house, pay off debt, or just get ahead in an incredibly difficult economy. But if you hand them that money the wrong way, the IRS has a series of hidden rules that will quietly penalize you, drain your retirement accounts, and legally seize the exact wealth you were trying to pass down. Most families never see this coming until the tax bill arrives in the mail, or worse, until the government denies them critical healthcare coverage years down the line. This is happening right now to millions of well-meaning parents and grandparents across the country. You write a check to help your son with a down payment, or you transfer the deed of your house to your daughter to protect it from nursing home costs, thinking you are doing the absolute right thing for your family's future. But without realizing it, you are accidentally stepping into a brutal intersection of the tax code, Medicare surcharges, and long-term care penalties. Today, I am going to walk you through exactly how these traps work, why the rules surrounding inheritance were quietly changed recently, and most importantly, the specific legal steps you must take to protect your life savings while still helping your children. If you want to keep your wealth in your family's hands and out of the government's pockets, you need to hear every single word of this. We are living in an era where the financial pressure on younger generations is immense. With housing affordability at historic lows, student loan debt acting like a second mortgage, and the cost of raising a family skyrocketing, it is completely natural for you to look at your retirement accounts and think, I have enough. I should help them now while I am still around to see them enjoy it. The instinct is pure. The instinct is rooted in love and protection. But the financial system is not designed to reward your generosity. It is designed to track the movement of capital and tax it whenever it changes hands. When you move money from your generation to the next, you are triggering a cascade of financial events that can jeopardize the very retirement you worked 40 or 50 years to secure. Let us start with one of the most common and devastating mistakes parents make, which is pulling money out of tax-deferred retirement accounts, like a traditional IRA or a 401k, to give to their children. I want you to imagine a scenario. Let us say your daughter has found the perfect starter home. She has a good job, she can afford the monthly mortgage payments, but she simply cannot scrape together the $50,000 needed for the down payment and closing costs. You look at your traditional IRA, which has grown beautifully over the years, and you decide to withdraw $50,000 to give to her. You figure it is your money, you saved it, and she needs it now. Here is exactly what the IRS sees when you do that. They do not see a father helping his daughter. They see $50,000 of ordinary income being added to your tax return for that year. Because that traditional IRA was funded with pre-tax dollars, every single penny you pull out is taxed exactly as if you earned it from a job. If you are already living on a pension, Social Security, and other investments, adding a lump sum of $50,000 on top of your existing income could easily push you into a much higher marginal tax bracket. But the income tax is just the beginning of the punishment. By artificially spiking your income for that year, you might trigger something known as the Social Security tax torpedo. Many retirees do not realize that their Social Security benefits are not entirely tax-free. Whether your benefits are taxed depends on a formula the IRS calls your combined income. If your combined income crosses certain thresholds, up to 85% of your Social Security benefits suddenly become taxable. So, by taking money out of your IRA to help your daughter, you not only pay taxes on the withdrawal itself, but you have now caused the IRS to tax the Social Security checks you rely on to buy groceries and pay your utility bills. You are being taxed twice for the crime of being generous. But wait, because the government is not done with you yet. Have you ever heard of IRMAA? It stands for the Income-Related Monthly Adjustment Amount, and it is a hidden surcharge attached to your Medicare Part B and Part D premiums. Medicare looks at your tax return from 2 years prior to determine how much you have to pay for your health care today. If that $50,000 withdrawal pushes your income over the IRMAA threshold, you will receive a letter from the Social Security Administration 2 years from now informing you that your Medicare premiums are going up. Sometimes, missing the cutoff by just one single dollar can cause your Medicare costs to jump by thousands of dollars for the year. So, your daughter gets a house, but you get pushed into a higher tax bracket. You lose a chunk of your Social Security to taxes, and your healthcare costs skyrocket. This is how the system quietly punishes you. Did you know that according to recent financial data, nearly 47% of parents are currently sacrificing their own financial security to help their adult children? That means almost half of the people watching this right now are putting their own 30-year retirement at risk, and the vast majority are doing it in the least tax-efficient way possible. Let us shift gears and talk about the second massive trap, which is the capital gains trap that catches families when they try to pass down real estate or highly appreciated stock while they are still alive. This is perhaps one of the most heartbreaking financial mistakes I see because it usually involves the family home, which holds so much emotional value. Let us say you bought your house 40 years ago for $50,000. Today, because of inflation and the real estate market, that house is worth $500,000. You are getting older, and you read somewhere on the internet that to protect your house from the government, you should just sign the deed over to your son right now. You hire a local lawyer, or maybe you just download a quitclaim deed online, and you transfer ownership of the home to your son. You think you have outsmarted the system. You think you have secured your family's wealth, but what you have actually done is handed your son a massive tax time bomb. To understand why, you have to understand a crucial IRS rule called the step-up in basis. When you leave an asset to your children after you pass away, the IRS steps up the basis, or the original tax value of that asset, to whatever it is worth on the day you die. So if you hold on to your house and pass it to your son in your will, the IRS says his new purchase price for tax purposes is $500,000. If he turns around and sells it the next day for $500,000, he owes absolutely zero capital gains taxes. He gets the entire $500,000 tax-free. But because you listened to bad advice and gifted him the house while you were still alive, the step-up in basis does not apply. Instead, the IRS forces your son to inherit your original purchase price. Your original $50,000 cost basis transfers directly to him. When he eventually sells the house for $500,000, the IRS will look at the transaction and say that he just made a $450,000 profit. He will be hit with a staggering capital gains tax bill, potentially wiping out tens of thousands of dollars of the generational wealth you spent your entire life trying to build. You tried to help him, but the IRS rules punished the transaction simply because you gave it to him while your heart was still beating instead of waiting until you passed away. This exact same rule applies to stocks, mutual funds, and any other highly appreciated asset. If you bought Apple stock in the 1990s and you gift those shares to your kids today, you are gifting them a massive future tax liability. The step-up in basis is one of the most powerful wealth-building tools in the American tax code, but it is entirely dependent on patience and proper estate planning. Bypassing it out of fear or an urge to be helpful immediately is a catastrophic financial error. Now, in just a few minutes, I am going to reveal the absolute most dangerous trap of all. I am going to explain a scenario where an entirely legal, IRS-approved financial gift to your children can actually disqualify you from receiving critical nursing home care when you need it most. It is a terrifying reality that pits two different government agencies against each other, with you caught in the middle. But before we get to that Medicaid nightmare, we need to understand a stealth tax rule the IRS just introduced that has turned the estate planning world upside down. In 2023, the IRS issued something called Revenue Ruling 23-2. If you have an irrevocable trust, or if you were thinking about setting one up to protect your assets, you must pay very close attention to this. For decades, wealthy families and middle-class families alike have used irrevocable trusts to shield their assets from long-term care costs and creditors. The strategy was simple. You put your house and your savings into an irrevocable trust. You give up a certain amount of control over those assets, but in exchange, the government cannot force you to spend those assets down if you ever need to go into a nursing home. And for years, estate planners believed that when you passed away, the assets inside that irrevocable trust would still receive that magical step-up in basis we just talked about, meaning your kids could sell the house tax-free. But the IRS changed the game. With this new revenue ruling, the IRS quietly declared that if the assets in an irrevocable trust are not included in your taxable estate when you die, they do not get the step-up in basis. Let me repeat that because it is vital. If your trust is drafted in a way that removes the house from your taxable estate, your children will be forced to pay capital gains taxes on all the appreciation that happened during your lifetime. The IRS basically looked at families who were trying to protect their homes from nursing home poverty and said, fine, you can protect the house, but we are going to tax your children heavily when they finally inherit it. This means that millions of older trusts sitting in filing cabinets across the country right now are ticking tax bombs. The families who set them up think they are fully protected, completely unaware that the IRS shifted the goalposts while they were not looking. If you have an existing irrevocable trust, it is absolutely critical that you have it reviewed by an elder law attorney to ensure it contains specific language that forces the trust assets back into your gross estate for tax purposes. If it does not, your attempt to protect your children from the nursing home will simply end up sacrificing their inheritance to the IRS instead. Have you ever stopped to wonder why the tax code is engineered this way? Why is it so complicated to just give your own flesh and blood a helping hand? The reality is that the government views the transfer of wealth as a taxable event, regardless of the relationship. They have created a highly complex maze of rules that assume everyone is trying to dodge taxes, which means honest, hardworking people end up getting caught in the crossfire. Which brings us to the absolute most dangerous trap of all. This is the one that bankrupts families. This is the one that forces adult children to drain their own savings to keep their parents in a safe facility. I am talking about the catastrophic collision between the IRS gift tax rules and the Medicaid 5-year look-back period. If you ask the average person how much money they can give to their kids tax-free, they will usually mention the annual gift tax exclusion. In the year 2026, the IRS allows you to give up to $19,000 per year per person completely tax-free without even having to file a gift tax return. If you are married, you and your spouse can combine that and give $38,000 to your child. You can give another $38,000 to your child's spouse. You can give $38,000 to each of your grandchildren. As far as the IRS is concerned, this is perfectly fine. It is legal, it is encouraged, and it is a great way to lower the size of your estate over time. Because the IRS says it is okay, parents assume it is safe. So they help their kids. Maybe you give your son $20,000 to help start a business. Maybe you pay $30,000 toward your daughter's wedding. Maybe you help pay off your grandson's student loans. You do this out of the goodness of your heart, relying on the fact that the IRS allows these tax-free gifts. Then, 3 years later, you suffer a stroke, or you are diagnosed with early-stage dementia. You reach a point where you can no longer live safely at home, and you need to move into a skilled nursing facility. Nursing homes currently cost anywhere from $8,000 to $15,000 a month. Very quickly, your remaining life savings are completely wiped out. When your money is gone, you apply for Medicaid, which is the government program that pays for long-term care for people who have run out of funds. When you apply, the Medicaid caseworker will ask for 5 years of your financial records. Every bank statement, every canceled check, every brokerage account ledger, they are looking for anything they consider an uncompensated transfer. They will comb through your records, and they will find the $20,000 you gave your son for his business. They will find the $30,000 you paid for the wedding. They will find the student loan payments you made for your grandson. You will try to explain that those were legal gifts. You will point out that the IRS allows you to give $19,000 a year tax-free. And the Medicaid caseworker will look at you and say, "We do not care about the IRS." Medicaid and the IRS are two completely different government entities with completely different rule books. The IRS cares about collecting taxes. Medicaid cares about making sure you are completely broke before they spend taxpayer money on your health care. Because you gave that money away during the 5-year look-back period, Medicaid will calculate exactly how much you gifted, and they will divide it by the average cost of a nursing home in your state. The result of that math equation is called a penalty period. It is a specific number of months during which you are medically approved for a nursing home, you are completely broke, but Medicaid refuses to pay for your care. Who pays the bill during that penalty period? The nursing home will turn to your children. They will look at your son who got the business loan and your daughter who had the wedding, and they will demand payment. If your children do not have the money, the nursing home can and will evict you for non-payment. This is the ultimate punishment for helping your children. You followed the IRS rules, but because you did not understand the Medicaid rules, you accidentally disqualified yourself from health care when you were at your most vulnerable. Your attempt to help your kids financially ended up creating a massive, unexpected financial crisis for them right as they were trying to deal with your declining health. Most families have absolutely no idea that a perfectly legal IRS gift can trigger a Medicaid penalty until the caseworker denies their application. So, how do we fix this? How do you help your children survive and thrive in this economy without destroying your own retirement, triggering tax torpedoes, or violating Medicaid look-back rules? The answer lies in strategic, intentional planning that uses the tax code to your advantage instead of letting it use you. First, if you want to help your children financially, we need to look at where the money is coming from. Instead of pulling from a tax-deferred IRA and triggering income taxes and Medicare surcharges, look at your taxable brokerage accounts or your cash reserves. If you have a brokerage account with stocks that have not appreciated much, selling those and gifting the cash is vastly safer than touching your retirement accounts. If you have a Roth IRA, you can withdraw your original contributions at any time, at any age, completely tax-free and penalty-free. The IRS cannot tax you on Roth contributions you take out, and it will not affect your Social Security or your Medicare premiums. Second, if you want to help your grandchildren with their education, do not just hand a check to their parents. Instead, utilize a 529 college savings plan. The IRS has a special rule for these plans that allows you to front-load 5 years' worth of annual gift exclusions all at once. In 2026, you could deposit $95,000 into a grandchild's 529 plan in a single day, tax-free. That money grows tax-free, and as long as it is used for qualified education expenses, it comes out tax-free. This is one of the most powerful ways to transfer generational wealth and secure your family's educational future without triggering a taxable event. Third, if you want to pass down highly appreciated assets like the family home or stock portfolio, you must respect the power of the step-up in basis. Do not transfer the deed to your children while you are alive just because you are afraid of probate or nursing homes. If you are worried about long-term care, you need to sit down with a qualified elder law attorney and discuss an intentionally defective grantor trust or a Medicaid asset protection trust. These specific legal instruments are designed to protect the house from the 5-year look-back period while simultaneously retaining the step-up in basis for your children. They are complex, they require specialized legal knowledge to set up, but they are the exact shields wealthy families use to protect their estates, and they are available to you as well. Fourth, you have to stress test your own retirement before you give a single dime away. You need to sit down and run the numbers on what your life looks like if you live to be 95 years old, if inflation stays high, and if the stock market goes through a severe downturn. You cannot help your children if you become a financial burden to them 10 years from now because you gave away too much too soon. Sometimes the most loving and protective thing you can do for your kids is to ruthlessly guard your own financial independence, ensuring that they never have to choose between saving for their own retirement and paying for your care. We have covered an immense amount of ground today, but I want to synthesize this down to the core principles you absolutely must remember. Helping your children is a noble goal, but the rules are stacked against you. Do not raid your traditional retirement accounts and trigger the Social Security tax torpedo or IRMAA surcharges. Do not give away highly appreciated assets like your home while you are still alive, or you will destroy the step-up in basis and hand your kids a massive capital gains tax bill. Be hyper-aware that the 2023 IRS ruling on irrevocable trusts may have secretly compromised your existing estate plan. And above all else, never forget that a legal, tax-free gift in the eyes of the IRS can still trigger a devastating penalty period with Medicaid if you need long-term care within 5 years. You have spent a lifetime building your security. You have sacrificed, you have saved, and you have played by the rules. Do not let a well-intentioned mistake in the final chapters of your financial life undo decades of hard work. Take the time to plan. Consult with professionals who understand the intersection of taxes, estate planning, and elder law. Protect your wealth so that when the time comes, it serves your family exactly the way you always dreamed it would. I want to hear from you because this is affecting families everywhere right now. Have you or someone you know ever been caught off guard by a tax bill after trying to help a family member? Or have you had to navigate the nightmare of the Medicaid look-back period? Tell me about your experience in the comments below, and let's figure this out together. If you want to understand even more about how these specific gifting rules interact with Medicaid and capital gains, watching this breakdown of the retirement gift trap will give you a deeper look into protecting your assets.